We've got some breaking news. The Congressional Budget Office warning that the federal government could run out of money to pay its bills on time as soon as August if lawmakers fail to raise or suspend the debt limit. Now, since January, the Treasury Department has been using special accounting maneuvers to avoid breaching the debt ceiling. The current House plan calls for a $4 trillion increase to the debt ceiling, a measure some Senate Republicans bump up against. Congress has limited time to get a plan through as the Bipartisan Policy Center projects the federal government could run out of money between July and October. And of course, now we have SIBO saying that X date is August. Joining us now to discuss, Rachel Snyderman. She's the Managing Director of Economic Policy at the Bipartisan Policy Center. Rachel, great to speak with you. Just want to get your thoughts on SIBO announcing this X date, Treasury risking payment default as soon as August. How big of a risk is that in your view?
Thank you so much for having me back. And, I think this latest figures from the Congressional Budget Office are in line with what we're seeing here at the Bipartisan Policy Center, that lawmakers have a window, later this summer, potentially even into early October, where they need to take action to address the debt limit, either further raise or suspend once again the debt limit. This is an issue that Congress has repeatedly flirted with, increasingly so over the past decade plus, but it's not one that we need to take lightly. There are several fiscal milestones that Congress is dealing with, from extending tax cuts to soon dealing with appropriations. But when it comes to the full faith and credit of the United States, this is certainly one that needs to rise right now to the top of the priority list.
Given that the debt ceiling has kind of been roped into reconciliation, how complicated does that make the path forward to lifting the debt ceiling in your view?
Goodness, well, it is quite complicated. I mean, a stack of dominoes is certainly no joke. I think that we saw, as you noted, in the House budget resolution, a $4 trillion increase to the debt limit passed there. But it's important to note that is just the beginning of the budget process to kick off. And the Senate did not have such an increase in their budget resolution. So right now, Republican leadership in the House and the Senate need to reconcile over what to do with the debt limit. Whether or not they're going to need Democratic support will really hinge on whether they can make this deal with the debt limit in a partisan reconciliation process. We saw President Trump also come out and request this be taken care of in forthcoming tax legislation. But, if, for example, a reconciliation bill slips further into the calendar year, and we receive, for example, tax receipts come in lower than anticipated, or natural disaster spending with hurricane season starting in June really tick up, we could see the X date falling earlier in that range. And if that doesn't line up with the reconciliation process, there will need to be another vehicle through which Congress needs to either, again, raise or suspend the debt limit.
And of course, there's also the potential of the market reaction. Bob is still with us, so I wanted to ask you, how are you thinking about how the bond market might respond if we just keep lifting the debt limit over and over again? We might have bond vigilantes coming in, and then that could be a negative for the stock market as well.
Absolutely. And I think the worry here is that the Fed is stopping their QT program here right now, and which is on the one hand is a good thing, but also which they're going to stop buying bonds. But on the other hand, who's going to be buying all that supply of bonds over the coming years when the Treasury has to continue to raise more and more money to pay for this debt? Once Maddie, later this year we may hit that magical $40 trillion level of debt, and it's unheard of. It's an unfathomable number, and unless they get it under control somehow, the bond market at some point in time is not going to be happy about it, and we're going to see yields starting to rise. Look, more recently, we've seen yields creeping up. The 10-year yield is telling us that inflation is sticky, and inflation is sticky. That also says that bond traders really don't want to have anything to do with fixed income at this point.
Yeah, and Rachel, I want to bring you back into the conversation here. To what extent do you think this administration is really watching the moves of the bond market in reaction to policy that impacts things like the debt ceiling, for example? Do you think that's something they're taking into consideration as a risk for the economy?
I think it behooves them to do so, because we have seen, even in past debt limit impasses, such as in 2013, for example, Treasury bills that were maturing near or around the X date saw elevated interest rates. We saw increases in U.S. credit default swaps. We saw declines in stock prices for companies that were impacted by government spending decisions. And so, I think that even just the potential risk of a government default creates uncertainty in the market. And we know that shaken investor confidence when we're talking about investments. The safest investment, truly in the global financial system coming under question was certainly one that we would want policymakers in the White House to be fully aware of and concerned about. And again, we know the way out here, and it will require that type of compromise and quick action on behalf of really, truly all in Congress and up and down Pennsylvania Avenue.
So, Rachel, clearly the Trump administration has embraced supply-side economics as its MO for increasing economic growth, but of course that means that tax cuts are a focal point for the administration and for the economy. But you mentioned that tax receipts could fall rather short this year with high tax rates that we have currently right now from the prior administration. What do you think is the effect going to be if tax cuts do happen maybe in the next year, 18 months, and tax receipts fall even more, and perhaps some of those supply-side policies don't get implemented until maybe the out years, maybe 5, 8, 10 years from now?
Well, you bring in the uncertainty surrounding tax season, especially when we're looking at revenue volatility. I mean, that's always the hardest cash flow, indicator for us to predict. And the coming weeks are going to be extraordinarily important for narrowing that range. As we're thinking about kind of longer term impacts, I think that this really calls into question our broader fiscal outlook. We're talking about the fact that we have a $36 trillion national debt, tax cut extensions that could add a potentially $4.5 trillion to that, if not fully offset or coupled with new revenue options or decreases in government spending. Also, the need to really tackle the fact that entitlement programs are where a lot of that autopilot spending is happening, and that just paying interest on our national debt is becoming kind of the third largest budget outlay. And so, I think that it's important that, in the context of the conversations that are happening on Capitol Hill, that we not lose sight of the fact that, yes, we are talking about further increasing the debt limit just to avoid default, but it's really time to get our fiscal house in order and have conversations across the aisle about the fact that a $36 trillion and growing national debt is not sustainable. I think that has to start with the fact that debating over just a blanket extension of $4.5 trillion dollars in taxes might not be the most fiscally responsible decision at this time. But we've seen that, in past tax legislation, but even back in 2017, there were revenue options on the table as well that were passed into law. So we've been here before. We can do this again. And there are several options on the table that BPC has provided and is willing to be here.
Yeah, never-ending movie when it comes to the debt limit, as you know well, Rachel. Thank you so much for joining us and breaking that down. Really appreciate it.
Thank you.